and let's get it underway. So what we're going to cover today is what some of the different types of crowdfunding are, and with a particular focus on regulated crowdfunding, particularly here in Australia. We're not looking at American models at all. The whole financial fiduciary system over there is very, very different to what we've got here. So I want to make sure that we cover off what's particularly in Australia. And then we're going to look at what you need to consider before you go and jump into any kind of crowdfunding to raise funds to increase your business. This is a live webinar today. So if you're on Zoom, you're seeing me live. Hi, that's not a real office behind me. That's a repeating looping video. You can see where it glitches occasionally. Sort of look kind of trendy. I look like I'm like a big corporate high flyer if I've got an office of people behind me instead of the mess of boxes and green screens that I have really got behind me. What we're going to do though is record this and put it on YouTube so you can actually watch this later. Now, before I get too far underway, I just have to put in front first that this document's or this presentation's only to be used as a guide. There's certain regulations that are on screen that you can read that have more comprehensive details of preparing for and running a crowdsourced funding campaign. Now, there's rules and regulations that can change at any time, and it's utterly recommended that you make yourself much more familiar with the legislation. The presenter, me, provides recommendations for preparing material in relation to running one of these campaigns. However, ultimately, it's your responsibility to ensure that you meet all regulatory requirements in relation to preparing and running a crowdsourced funding campaign. The financial disclaimer here is that info provided in this is general in nature and does not constitute financial advice. I am not qualified to give you financial advice. Whilst every effort's made to make sure everything's accurate in here, you need to consult a financial professional first before you make any financial investment decisions. We recommend you consult a planner or an advisor to take into account what your particular circumstances are before you take any advice from this. Myself, Business Station, and Startup Territory do not give any warranty as to the accuracy, reliability, or completeness of information which is in this presentation, except insofar as any liability that's under statute that can't be excluded. Both myself, Business Station, and Startup Territory, one of my businesses, and its employees don't accept liability for any error or omission. This is horrible, isn't it? I have to read this at the beginning of it, or any resulting loss or damage suffered by the recipient or any other person. Overall, what that all means is go and get advice from a financial professional before you start acting on any of these things. I'm not giving you advice, just letting you know what's out there. Another disclaimer is, this final one, I promise, I have a pending commercial arrangement with a crowdfunding platform that is not mentioned or promoted in this presentation. So I'm maintaining distance from any conflict of interest, and I won't be mentioning the name or the status of that particular platform I'll be working as a scout with. With that out of the way, hi. That was a lot of mouthful to have to read. My name's Dante. I've got a whole lot of qualifications and things. I work with a whole lot of organizations that I won't bog you down on. Basically, I'm probably one of the leading digital and startup trainers in Australia, simply because I just make sure I'm in the right place at the right time to be able to help out people with things like this. My foray into the startup support world has been more recent, and probably in the last 2 years. And through that, I've been able to work with some incredible organizations and people who are in that startup community right around Australia, including Silicon Beach, Australia, and others that I'm not allowed to mention quite yet because they're still pending arrangements. So, what's this crowdfunding thing? You're probably thinking of GoFundMe and Kickstarter. And while they are certainly part of it, a crowdfunding campaign is basically where small amounts of money are invested by lots of different people to meet a goal amount needed by a business to fulfill a specific growth project. So you, as a business, want to grow your business, you need to get a bit of equipment, you need to spend a bit on shop front or fit out or something like that. You don't have the money, you don't want to get a loan from the bank, you don't want to get a business partner or a venture capitalist to sort of take over your business. Then crowdfunding is a way of helping to get that money. It's usually a very specific goal that you're trying to get. And generally people don't invest more than, say, $1,000 to $10,000 at any one time into the things you're doing. The difference between a venture capital, where you usually get one investor who comes in with a whole lot of money to take a whole lot of your company. This is not Shark Tank. This is more like, there could be 10,000 people out there who are all investors through particular platforms, and they may give you $1,000 and they get a very, very small piece of the company that only gets paid out when, say, for instance, you choose to pay dividends as a company limited by shares, or if you sell the company to a bigger entity and part of those profits go to dividends to those initial investors. More about that to come a little bit later on. That's not the only kind of crowdfunding. What we might look at is probably some examples of where crowdfunding has been helpful to different business types. And these are three very different businesses that have a very similar problem. Let's just say you're a gin distillery. You've got your own gin distillery you've set up and you want to bottle, you're currently bottling 200 bottles a week, and you've just got an order from Dan Murphy's, who is agreeing to stock your gin on their shelves, but you need to produce 20,000 bottles a week to do this. But to do that, you need $250,000 to buy machinery to help you to bottle that many things of gin. You can produce it, you just can't bottle it because you don't have the machinery, and you can't just keep throwing people at the problem because there's no room. What you would want is $250,000 to help you to bottle up that many a week. So the investment is to help you to basically increase your volume and therefore your profit as well. Similarly, it could be a sneaker cleaning business in a Melbourne laneway. And with that, you are looking to expand yourself out of that laneway into other locations and also increase your online products. So you've got sneaker cleaning kits that you want to be able to set up a Shopify site and spend $20,000 setting up a really good e-commerce front to be able to do that. Well, this could be part of what you're trying to raise money for, is to open up a couple of shops and fit them out in various other places around Australia, and also set up your e-commerce site to get you into the digital world, to sell your sneaker shampoos and your sneaker conditioners. Yes, and they are actually things, the cloths, the brushes, all the things that come with the paraphernalia of looking after an expensive set of collector sneakers. Another one might be a storytelling-based guided tour company who wants to be the Airbnb of tours. They don't want to have to go through the usual travel agents. They don't want to go through the normal tourism associations. They want to do something different that's outside of the norm. Just in the same way that Airbnb has sort of shaken up the hotel industry, they are looking to shape up the tour company industry, where things like AP Tours and Murray's Tours and all those seem to have the whole thing sewn up. These guys are doing something a little different. They want $500,000 to build out a really solid online platform like Airbnb that connects them easily with people who are looking for a very different bespoke experience, but it might come at a cost that's quite a lot less than these high overhead tour companies. And with that, they also want to help to recruit more storytellers, or they're guides, basically, more guides, that they call them storytellers, into their business in more markets. So they need quite a bit of money to market out to people who will do those tours for them in those markets. So all of them want some money. They've got a very defined idea of what they want to do with that money, and they're able to communicate what it is they want to do with it. So now what we're going to do is look at the different ways they could do that. And crowdfunding isn't all the same. There's very different platforms, very different methods of doing it. So we're going to look at what those are. The four main ones we're looking at are reward-based crowdfunding. So we'll look at that as something like Kickstarter, for instance, and I'll explain why. The second one could be donation-based crowdfunding. That could be something like GoFundMe, which there's no obligation for you to do anything or pay anyone back, because you're just raising money to do a certain project. And then, it's just sort of kindness of people's hearts that they're going to help you out. Content-based crowdfunding is more like, strange enough, OnlyFans. Hopefully you don't know what that is, but it's basically gating content with payments so that people can access online content with a payment they give to you to access that payment. I'll explain more about that shortly, as well as regulated crowdfunding, which is really what we're here to talk about a lot more today. But first, I want to sort of give you an idea of what the crowdfunding environment's like, because it's not necessarily all the same. These are very, very different approaches with very, very different legal structures and very, very different kinds of money that you can raise through them as well. So Kickstarter and Indiegogo, if you ever come across those, the camera I'm using right now on my laptop computer is actually a Kickstarter. It's an AI-powered camera that does a little bit more than just putting my face on the camera. It can help follow things. I've turned off all the features because they kind of glitch out a bit on my Mac sometimes. So they can, like, if I was lean over here, that camera usually would follow me over and put me back in the center of the screen. And it also helps when I'm moving around to stop the background glitching so badly. Now, like I said, I turned all that off, and I bought that on Kickstarter and it was delivered. So the reward for me putting $299 into this particular Kickstarter project was to get the camera. And that's now been delivered. I'm using it. I'm really happy with it. It's a product that's just about to get another update installed on it, which is going to fix the little glitches I've been having. It's a great little tool, and I have no regrets on buying it. Is it expensive for a webcam? Yes, but I do a webinar a day. and I do lots of Zoom calls every day. I need a decent camera that's going to be a little bit better quality than what, say, for instance, the one that's built into my Mac or my PC would be. So what it does, it offers you a reward for your investment. You invest something, you go, I'm going to put in $50, for instance, and then your reward might be getting a t-shirt. Now, you won't get the product the company makes, but you might get their exclusive t-shirt for supporters. The idea is you're supporting things that you believe in, and you get a reward for that, not necessarily the product. In this case, the reward was the product. So I was essentially buying the product. The danger is, though, with Kickstarters and Indiegogos, that sometimes these projects never deliver, and that can get into a bit of trouble, especially if you're collecting the money along the way and then you don't deliver the product and people start demanding their money back. That's where things can get a little bit messy. The reputations can be ruined. You don't have to pay that money back necessarily if you don't deliver, because there is risks inherent with both Indiegogo and Kickstarter to be able to do those. The idea generally here is what most people will do. They want to produce a thing. Let's just say a friend of mine in North Queensland produces these kind of semi-precious polished stones that they use for massage stones. So this one's comes from Afghanistan. So it's quite rare at the moment. You can't really get much out of Afghanistan with those. And he wants a machine that's going to help him to tumble and polish these stones at a rate of 200 a day. So to do that, he's putting a Kickstarter on there to say, hey, I want to produce this amazing product, but to do it, I need to be able to get 200 stones a day polished, as opposed to at the moment, I can do about 1 or 2 at the absolute maximum. And so we go, oh yeah, I really believe in that. I'm going to put $50 in as a donation, and he might send me a newsletter, a sticker, something like that. Or what he can do is he can use that money to basically deliver some of those stones that he's been able to produce on that new equipment when it's actually delivered, when he reaches his funding capacity and he says, okay, I've made that $75,000 I wanted for the machine. Now I'm going to grab it and I'm going to put it installed in my shed, and we're going to start tumbling stones. And if you were someone who put in $400, for instance, or $500 as an investment for this, then you get a set of stones for $500. For $400, you might get a couple of stones. For $800, you probably get it boxed in a velvet container as well, so that's very well presented. And if you're investing something like $3,000, you might get a full set of complete massage stones in 3 different stone types. So you're being rewarded for your investment in product, not in dividends, not in money, not in payout. No one's getting a piece of your company. No one's taking a percentage. All it is that you're making that money. You use the money for what you said you were going to do. You keep your backers happy, and so they don't start sort of, trying to ban you on the platform and get you in trouble with various laws around the place. So you deliver what you said you would deliver, and people are happy, and you move on, and you've now got increased capacity in your business to produce more of these little massage stones. All sounds really great. And these things do sometimes fall down. I've lost out on a couple of Kickstarters I've backed that haven't delivered it. There was like a portable screen for laptops sort of setup that didn't work. I lost money on that one, about $300. But then everything else, a podcast studio system, which I bought for $400, I use every week to do my podcasts and interviews and different online videos and things. So sometimes they pay off, sometimes they don't. For you as the person raising the money to do this, the biggest danger you've got is brand reputation if things don't happen, if you don't deliver on what you said you're going to deliver for those rewards. Now, you can also base it on like rewards that don't have to be product. They can be rewards that are like supporter t-shirts, swag, all that sort of thing that let you, share them in the journey and the support of your product without actually having to give them the product at the end. But the best ones are always, you're making a gadget, you're making a thing, you're making a physical item, a product, and then the rewards are you get that reward as part of your backing that you're given. Because remember, you're getting that backing usually to make the product that you want to make, not necessarily to scale up a business. That's not really the role of these kind of things. This kind of thing's really good for very innovative ideas. So if you've got like a camera that's got AI built into it, you've got an app that you want to build, which is very, very different to every app that's out there on the planet. It could be a status symbol product. It could even be a book. I've seen some Kickstarters work really well for well-known people to produce their first book. So they're people who have enough of a profile out there, and they decide to use Kickstarter or Indiegogo to fund them to be able to make a book, to spend 12 months writing and publishing a book. Generally, the things that work best here have a global appeal. So they wouldn't be things that are just an Aussie thing. You'd want this to be quite global. Can be an Aussie product, but it has to be something which you're willing to sell offshore as well. Things that are very on trend, anything that's AI or metaverse related at the moment, or to do with making life easier or disrupting things that are already there, or that support some kind of cause and puts the logo of that cause on a drink bottle, for instance. That kind of stuff does really well. It's where you've got a very good, solid grasp on social media. If you've got some good momentum on social media, Indiegogo and Kickstarter are a fantastic way for you to raise money. And it's very small. Like, you're not going to raise millions through this, although some have. I remember when the Pebble watch, which was later off bought by Fitbit, I think. A Pebble watch was one of the first smartwatches that was ever made, and it was it had a fundraising of about $30 million when it first went to raise the building of that particular smartwatch. So that was a particular. I bought one of those back then from Pebble as well on Kickstarter about about 15 years ago, before we had Fitbits, before we had Garmin's, before we had all those Apple Watches. It was a great way to launch a category, and they were great little products. I really liked my Pebble. It's so simple, it just worked. These sort of things work really great. Things like that have a difference to a thing that's already there. So, for instance, someone I saw was selling a cap that had removable and replaceable flaps on the back to keep the sun off your neck. Most of those just have a flap on the back, and then you're stuck with what you're stuck with. But this one was like a color cap that you could then put an attachment on the front that would make the cap a different color, as well as the back of it a different color. So all you'd do when you want to change your look, you'd literally just buy the cover, and then it would completely change the cap and change the look. So great little tool. I don't know how well it did. I didn't buy it because I don't really have a need for that, because I've got so much hair on top of my head that obviously I don't need a hat or anything like that. So I'm assuming it went well. Last time I looked at it, it was doing pretty well. So that's Kickstarter and Indiegogo, which are what we kind of think of as the crowdfunding platforms. But there's a whole other world of them. And these ones are the donation-based ones, things like GoFundMe, Fundly, and Fundraiser. These are mostly around causes. So this is when you're trying to raise money for a cause, a community benefit. It could be for flood relief. It could be for helping little Johnny go off to boarding school in America, or little Cassie going off to a gymnastics camp. Just little things that are just raising just enough money to make a certain thing happen. These are very strongly tied to a story that's inspirational, something that has a community benefit, something which is seen to benefit the world and make the world a better place, or somehow inspires people to want to be part of your mission. These things are very mission-based. They're very much about, relief in Ukraine, relief for flood, relief in disasters, helping people who are disabled to be able to get a ramp installed onto their home. Little campaigns that are basically feel-good stuff. They're humanity things. Now, if your business is all about that, this could be really good. I work with a guy sometimes who makes sports wheelchairs, and he used a GoFundMe to raise money to set up his workshop to be able to make sports wheelchairs. So for wheelchair basketball, wheelchair rugby, all that sort of thing. And he raised enough money to set up his small, modest workshop to get that started. And he's now got a business doing that particular thing. So this is a great way of starting things like that. These are very small things. This is not big, huge ideas and projects. You're not going to build the next Airbnb or Facebook based on donations like this, but it might get you started on building something which is needed in your community. When it comes to content-based crowdfunding, however, this is where things get a little bit different. So this is where someone has got maybe a course, an online course they want to run, and they want to be able to raise the money up front before they make that course. Now, these kind of things are very useful for people to express their interest and put an investment in for something you have not necessarily created yet, but you are going to create and provide. Facebook allows you to do fundraising for causes, but also for yourself. You can fundraise for yourself. You can ask for money to be raised for yourself, and you collect that, and it gets paid out a certain percentage. If it's charity, it doesn't. There's no payout percentage. It just gets paid through. But for people individually, you can actually raise money for yourself if you like on Facebook. There's nothing stopping you doing that. There's a particular fundraising tools that allow you to do that. So off you go. You can do that straight away from your Facebook account through a page, through a group, through live videos. It's really, really well integrated in. Now, this is all based on like people being able to give money to you for something that allows them access to special content. In OnlyFans case, that can be of more of a sexual nature, mostly, but there's some very clever people on OnlyFans who actually like artists and singers, dancers, performers, musicians who provide OnlyFans access. For someone paying, say, $25 a month will get exclusive access to all their live performances this month, which will be streamed through OnlyFans. So you only get that if you are a subscriber through OnlyFans. Likewise, Patreon is another system and platform which allows you to collect payment for content you're going to create, or collect payment to ensure that you're supporting the people who are creating content you like. Say, for instance, you happen to be really like mad keen on Star Wars and Star Trek content from some of your favorite creators and sharers on YouTube. They'll often connect themselves through a Patreon account where you can pay into that. So you can give them, $25 a month to continue to make their content. You're supporting them to provide that content to you. Now you might think, oh, why would I give a YouTuber $25 to produce that? As an example, I watch more YouTube than I watch of any other streaming or even TV. YouTube is my number one place to watch things that entertain me, that have got to do my interests and to learn from. So for me to go, if I want to ensure that the person who produces the stuff that entertains me the most, I want to ensure that they continue to do that. I could use Patreon to pay their $5, $10, $15 a month with which to support them. So you as a content creator would say, I'm going to create this content. This content's only going to be available to people who pay me. So you use these platforms to collect that. So that's content-based crowdfunding. The big one we're probably looking at, is OnlyFans and Patreon. Really, the Facebook one's sort of starting to get momentum too. Very good for causes, very good for content creators, very good for influencers. So people who are creating content about themselves. It's good for small amounts of recurring revenue, particularly OnlyFans and Patreon is like a subscription model. So Facebook has a subscription model for groups. So you can take payment for people to join your group and it'll allow them access to that group only if they are a paying member. So it's very good for those who are producing things like courses. If you're producing things like your speeches, your lessons, your classes, your thoughts and feelings every day, your expertise on a particular topic where you're going on every week and producing a video that's got to do with that, and you want people to have to pay for that, these platforms are great for that. They pay out pretty quickly too. The system we want to talk the most about today, though, is the one which is really helping small businesses to scale up in Australia, particularly, which is, I call it regulated crowdfunding. So it's this legal stuff you can do. It's there's only 16 platforms licensed in Australia to do this. Virtual is one of them. Equitize another. Swarmer is another one. These are particular platforms that are made for businesses who need to raise money in a way that's legal, and it helps them to be able to set up the structure of business that allows them to do this. And what I mean by this is going to be businesses that want to scale up, businesses that already have some popularity to them. Got an example, Black Hops Brewery. If you've ever had their beer, apparently it's really good. I'm not a beer drinker, so I would have no idea, but it's apparently really nice craft beer. They wanted to be able to scale up their production, to be able to produce more so they can put themselves into Dan Murphy's and other bottle shops and to be in the shelves and the fridges of more pubs. So to do that, they needed a bottling machine that allowed them to bottle things at 10 times the rate they currently can. So they wanted to raise $500,000 with which to install that machinery so they could become a more scaled up bottling of beer provider. It's for big ideas. It's way less complex and dangerous than venture capital and taking on business partners, because everything's kind of managed through the platform itself. So Virtual and Equitize and others will, and there's some really awesome ones out there. There's another one called Venture. It'll come up later on. I've got the thing for it later on. Venture capital, something like that. And it's all to do with basically getting you in and educating you about what you need to do in order to qualify for this kind of thing, because this does have certain fiduciary and legal responsibilities that come with it. You can't just go and start giving away pieces of your company without having a company that you can give away pieces of. Now, raising through regulated crowdfunding happens to be sort of around the idea of you want to raise money, investors are looking for investments, and these platforms act as an intermediary. So they provide the platform where people can invest into it, but they also go a little bit further. Rather than just being a platform where they collect the money and then you take the money out, it's about a lot of mentoring and support as well. It helps you to prepare your business for the investment process. These platforms also help you to handle investors, and they teach you how to work with investors and what is the appropriate way of working and communicating with your investors. They go through the idea of how to pitch your idea. So how you can produce the right kind of material that gets people inspired enough to want to work with your business to help it grow. How to find the investors, which they do themselves. You don't have to look for investors. All you'd have to do is follow this particular routine that they have. It's a 4-step routine in most cases, and they find the investors for you. So they do that part of it for you. And they also make the investors aware of your idea. What all these platforms do is have up to hundreds of thousands of people who have expressed an interest in crowdfunding programs, and they want to be able to invest in crowdfunding opportunities. And so all they do is activate that network and say, here's our latest investment opportunity. Have a look at this. And they'll look at it, and people will either commit on the fly and just go, yep, put in $1,000 in there straight away. And they've got all that preparation that they do with you before you go live on that campaign to be able to do that. So how it might work, there's Venture Crowd is what I'm looking for. Equitize, Birchal, and Venture Crowd are probably the 3 biggest in Australia of linking companies like you or businesses like yours with crowdfunding. Now, you can't just, again, go and do this on your own, or you have to use these particular licensed platforms to do it. But there are requirements. So you need, like a sole trader can't do this. If you're a sole trader, you can't do this particular model because you have to be a company. So there's certain things you have to be, which is a business to have a turnover of less than $25 million per year. I think, I don't think any of us in this particular class are probably have a problem with qualifying for that one. So you've got to be earning less than 25 million a year. The second one is, the raising is capped for you at no more than $5 million per company per year. So you can only make $5 million per raise, and you can have 1 raise per year of up to that $5 million. So you can have more than 1 raise a year, just as long as it's under $5 million. You can do 5 $1 million ones or 2 $2.5 million ones. All that's fine. So there are these are government and Australian Securities and Investment Commission rules that are in place for the crowdfunding platforms. Next up, retail investors, mum and dad investors, like people who are going through, I know, the Commonwealth Bank kind of things and St. George's direct shares and all that sort of thing. They can only invest up to $10,000 on each company annually. So they can go to lots of different companies and invest. They can invest $1 million if they want, but it has to be in lots of different companies. They can only invest up to 10 grand at once. This is to protect mum and dad investors who may not be as well educated or prepared for the losses that can come from these particularly risky investments, from betting the farm basically on a crowdfunding platform. So it keeps that in check. But if you happen to be one of the 1% of the 1%, those with over $250,000 of gross income per year and at least $2.5 million in assets can invest as much as they like. So this could be some boomers are out there who are in the peak of their career and earning their peak money, but they're also own 15 properties. They can probably get away with doing more. They can have any investment amount they like. It's considered that if they've got $2.5 million in assets and they invest $1 million and lose it, they've got $2.5 million in property they can sell off to recoup that particular investment. So again, ASIC rules, not the platform rules. The next one is that you need to be a proprietary company, so a proprietary limited with a minimum of 2 directors. So you can't just be the director yourself. It can be you and someone else has to be a director. Or you can be a public company limited by shares. So you need to be one of those 2 things to be able to do that. Now, a public company doesn't necessarily mean that it's listed on the stock exchange. A public company and a listed company are slightly different things. So you need to be at that point where you've incorporated and you've got 2 directors in there, which is usually you and the missus, or you and the business partner, or you and your son, or you and your daughter. Something like that is a setup. Next up, you need to be principally located in Australia and have the majority of your directors in Australia as well, residing in Australia. Now, you might be going, oh, look, like half of the year, one of you might live in Brunei or in Bali or somewhere like that, or Lombok, that's fine too, as long as your primary address is within Australia and you are ordinarily, you're considered to be a resident of Australia. So that's what it might be a bit of a killer for some people's plans, but honestly, this is a very, very simple thing that keeps it within Australian law and not be a listed stock exchange company. So you're not going to be on the ASX as a company that's got lots of shareholders and all that. You can be a public company, but not a listed company. So there's a big difference there. Next one is, you can't be a company who mainly makes your money by investing in other companies or entities or schemes. So you've actually got to be producing something or doing something before you can become someone who goes into a crowdfunding campaign. So if your thing is to raise money to be able to invest that money into schemes and investments, that's not what you're able to do on a crowdfunding platform. You're only allowed to be a company that makes things or provides services that don't involve investing that money into other things. And not be a company who mainly makes their money by investing as well. So you can't be basically, it's the same thing. You can't be someone who's making all your money for your business out of investing money. You've got to be making something or producing a service of some sort. So with all that in mind, that's the rules. What are the actual benefits of regulated crowdfunding? Why would you consider this to be a really good way of going about it? Well, the first way is because you help to raise your capital without what I call the wolf and prey mentality of what the venture capital and hedge funds are about. There's a certain aggressiveness and alpha kind of behavior that comes from venture capitalists and hedge funds. These are hardcore investors who may invest in 10 different things a year, and 9 of those things may fail, and 1 of them will be a success and will make them all their money back again. But they do not deliberately go into high-risk areas which have no chance of succeeding. There's got to be some kind of chance of success. Now, the more money that a venture capitalist or a hedge fund wants to invest into your business, the more percentage of your business they're going to want to get. So they'll usually go for the thing that gives them the most control and the least risk. So they would want much more control. They'll come in and say, I want 51% ownership of this company. And you'll go, no, you're not getting majority ownership, up to 49 and that's it. Or you might be like Shark Tank and you're saying for $250,000, you're going to get like 2%. And then they become a minor shareholder. You become the 98% shareholder. They become a 2% shareholder. That can be very, very aggressive. The negotiations often have to happen between legal experts, teams of lawyers, teams of bankers, and it becomes horrible. This avoids all that. This is a much more scaled down, much easier to approach, and much easier to use system than doing that. The second benefit is that part of the process of crowdfunding puts it out to a lot of people. That increases your customer base and your marketing base quite a lot, because not everyone may want to invest, but they might want to buy your product or do your service. So if they see that come through, it's a form of your marketing as well. Now, someone may become an investor and a customer. That's great as well. They may not have known about you before then. I invested 2 weeks ago in a company that this is not investor advice at all, just saying it like to know who I've actually done something with. And it's with that company that was looking at the travel thing I explained before, where they want to be the Airbnb of tours. I invested a bit of money in that, the minimum amount, just because I believe in the idea and I think it's got a lot of potential for growth. But at the same time, I would probably become a customer of theirs. So if I start to see, they started, I think, in New Zealand and they're spreading to Australia now and then to the rest of the world. I would probably use their tours when I go on holidays within Australia, because I like the idea of storytelling and people presenting a much more bespoke experience of a tour rather than let's hop on a bus and quickly get to as many places as possible. It also helps you develop a brand following. People who are on these platforms are investors. They're not tending to be institutional investors. They're not tending to be hardcore day trader kind of investors. These are people who are investing for passion and for joy and for things. They're investing basically in things that they want to support and things they believe in. So when that happens, you're not just got an investor, you've got a fan, and fans will spread the word far and wide about who you are, what you do, and why people should care about you. You create loyal brand advocates through these processes. Unlike going for regular hedge funds and outside partners, you only really might approach 5 people and one of those might say yes. the marketing potential for this is far greater, that you're going to get product and your product in front of people much more. You're going to go out to a database of 120,000 people often with these, because these companies that do crowdfunding, regulated crowdfunding, have massive databases of lots of people. So you're suddenly going to be in front of a whole lot of people, and investors are usually people who've got money and disposable income. So they're people who may buy your product or use your service as well. Another advantage is you're laying the foundation for the future of venture capitalists and angel investors if you want to bring them in at the end. So by providing a lot of very quality signals and a lot of really good background work on setting you up and taking away a lot of the risk of your business and making it a lot more of a solid structure, often with the mentoring of the crowdfunding platform, you lay that really good foundation. And later on, I've got some sort of venture capital versus angel investor versus crowdfunding platform stats you can look at, and some of the realities of, some further advantages of why you might want to use this particular platform to raise your money for your business. It also gives you access to a lot of people with a lot of skills. So the people who work with these platforms are venture capitalists themselves. They are also, so sometimes what will happen is that you'll go onto the platform to do the fundraise, and then they'll come in as a venture capitalist, say, hey, I will approach you privately and say, hey, how about we do this arrangement as well? So it introduces you to people. It gets you into that venture capital world without having to be suited and booted and turning up to Silicon Valley and New York City and London to be able to wheel and deal it with the giants. It allows you to have a taste of that within Australia, wherever you happen to be within Australia. It also taps into, and a lot of these, they have experts in different things. So the platform that I'm working with, which is not mentioned in this presentation, I'm one of their marketing consultants. So when someone comes into that and they go, okay, to get ourselves really set up well in the future, we need a marketing plan for this business so that people who invest know that there's a solid marketing plan for the future. And so I'll consult with the owner of the business to be able to help them create the marketing plan for that business, and often to work on their branding and their personal brands of their directors as well. Some of the platforms have people who will do the marketing work for you. Some of them have financial advisors, financial planners. Others have accountants who you can talk to, legal people. They've got lawyers who can help you to explain the legal, the legal things you need to consider along the way as well. They provide those experts to help to onboard you to this program. Now, of course, this is all going to cost something, and it does. And those costs are going to come up a little bit later, what you can expect a ballpark pay to get into this kind of thing before you've even raised a cent. You can also gift your product. So like Kickstarter, for instance, you can say, okay, if I'm producing a beer and I've got someone who's invested $10,000, we're going to give them a case of beer that's been custom labeled for their name, and they're going to get that as a thank you, as a gift for their contribution, because it's helped you to increase your capacity in your sales. You want to thank them with something special. And I know a lot of the craft beer companies who go through this process produce a specific beer batch for each one of they might have 100 investors. They make 100 cases of beer that are personally customized beer mixes and beer bottle labels made for those investors. So little gifts like that allow you to have even more, reach and more goodwill with your investors, because this is a long-term strategy. For someone to invest in you through a crowdfunding platform, they're not looking for an immediate return. They are not looking for anything for quite some time. They may not see a return until you choose to pay a dividend at the point of profitability, or if you sell the business to a bigger company and part of the proceeds go into paying the investors. So that's the kind of approach that's being taken by investors in here. They're not in it for a quick buck. They're in it for the long term, which takes a lot of pressure off you as the company looking for the investment for it. Next up, here's a little bit about the difference you'll find between crowdfunding platforms, venture capitalists, and angel investors. And they're all, angel investors and venture capitalists are kind of the same. Angel investors will probably have a lot less, they will come in with like a lot more money often, with a lot less strings attached. But venture capital often comes in with a lot of money and they want a great big chunk of everything, and they'll only ever usually have one of them. Angel investors, you may have 10 different angel investors coming in, but crowdfunding could be much greater. Now, in crowdfunding, you can set the terms. So what the percentages are that people get when they invest $1,000, you get 0.005% of the business, a share of the business. You set those terms. You set what the rewards are if you're going to do a reward. You set whether, if they invest more, they get a higher percentage, whatever it is. You set those terms with all of these crowdfunding companies. They will give you advice on what they believe is the most successful models to be able to crowdfund, but you essentially are the person who sets those terms. Venture capitalists, they are all about control and risk mitigation. So they'll come in and take control through things like preference shares. They'll make you agree to terms in the shareholders agreement that are in their favor, and they'll almost always try to take control of the board at some point. The amount of businesses who get venture capital raised, who get kicked out of their own companies for good and bad reasons. It could be all sorts of people, from Travis Kalanick from Uber being booted off the board and booted out of control of his company because of, a lot of harassment and sexual assault claims against from staff in his company. In that case, the investors very successfully kicked him off the board and kicked him out of the company, so that he was he's still the biggest investor in the company himself, but he's no longer running it. And so that's the sort of things that can happen if you're not willing to be battling a board that may be against you at some point. Venture capital is not a good way to go. Much the same with angel investors. They still try to get some level of control through very similar methods that the venture capitalists use, but because they've got a smaller share of the business than what venture capitalists do, they may not have as much power. So they will set all the terms and they'll make you agree to it so you can get the money. Whereas in this world of crowdfunding, you set those terms. The second benefit is that you set a value that you think is fair for your business. You might say that my business is valued at $2.7 million. And that is agreed. That's something you'll be advised by a financial planner. You'll be advised by an accountant. You'll be advised by the crowdfunding platform themselves on what the value is fair. But ultimately, you set the value of your company, which means you set the value of the shares that you're giving out. When it comes to venture capitalists, they actively try to drive down the value of your company so they can have a bigger part of it. Because they might say, I've got $1 million to invest in you. So what I've got to do is make sure that your share price is really, really, really low so that I can buy a huge chunk of it with the money I've got. So then I get as much ownership of that, as much control as possible. And they'll ultimately try to get to that magic 51% pit where they can essentially control the company without any of your input. The same happens with angel investors where they will try to, and often the different angel investors might be quite in with each other. They work a lot with each other and they'll do what they can to maximize their return, mitigate their risk by taking over as much as of your company as they can. They get over that magic 50% mark, the 51%, and as a consortium, then they can kick you out if they need to. So you get to set what you think is fair, as opposed to people who are deliberately trying to drive down the value of your business so they can buy more of it, and then the value will drive up. The whole pump and dump scheme. You come in, you bring the business down to the lowest possible point you can, then you pump a ton of money into it, which then makes the value of the company goes through the roof, because all of a sudden everyone wants to invest in it, and then they run off very quickly and make their quick buck, or they make a long-term view of it and they go, well, we're going to keep doing this in cycles, so over a period of 10 years this thing will be worth a lot. In crowdfunding, you can have 100 plus shareholders generally. You're going to have tons of them, tons of investors, and they're all going to be in there in a very small, tiny little way, which also makes them fairly low maintenance. What it does by having that many investors is that you may actually be able to prepare yourself for an initial public offering of shares. Now, to do an IPO, an initial public offering of shares through the ASX, the Australian Stock Exchange, you need at least 300 shareholders to be able to do that in order to launch. Having that 100 to begin with is a really good way to get it. That counts towards your 300. So if you do 3 different crowd raises over 3 years with an aim to get 100 different shareholders per raise, you've reached the 300, and then you can get to that point where you can then go and start to qualify for a launch on the ASX because you've got 300 plus individual shareholders. Now, a venture capitalist wants to be the only shareholder apart from you. You'll be a shareholder, they're going to be a shareholder, they become your partner in the business for all intents and purposes. They've injected a whole lot of money into it, so they want a whole lot of say on how things are going. And it may not be a good thing. Sometimes it's a great thing. It helps you not only with money, but with some mentoring to understand how to better to run a business. Angel investors can generally have between 1 and 10 shareholders, plus you. So that you're maybe sitting in a board with representatives of those investors. You could have 4 people sitting in a boardroom with you, and you may represent enough of the value of 51% to be able to outvote them all the time. But eventually, if one person buys out another person's and they become a bigger shareholder, you may be up against a very hostile other shareholder who is actually trying to push you out. When it comes to the help that's provided, you get lots of brand advocates who can support your business, and the crowdfunding platforms provide people to help you through the mentoring part of how you do this thing, how to deal with investors, how to get yourself to the right position to qualify for this sort of thing. When it comes to venture capitalists, they're in it for themselves, 100% into it for themselves. So they may give you some limited strategic and corporate advice to maximize their investment, but they will never, ever give you advice that's going to benefit you over them. The advice they give you helps you to become more useful to them. So just bear that in mind, that when it comes to these are professional investors, not the mum and dad investors like you get in a crowdfunding platform. So the process of how we do this, how do you go about getting yourself onto a regulated crowdfunding program? I drink straw. The problem with these paper straws is they disintegrate into your drink, and it's kind of yucky. So the pre-raise part of the process means that they're giving you the support you need for your legal setup, your planning, your tax setup, all that, to assist you to prepare for your crowd-sourced funding raising, and kind of getting you in the position where you're best prepared to be able to succeed from your raising of money. So this is something which you don't get from angel investors. You don't get from anything else, really. No one's going to help you with this stuff. The crowdfunding platforms are set up in a way that they actually have to have and offer this. It's optional for you to take it up. You can enter their platforms and not have any of their support and still do your raise. But you might as well use this because it's not going to cost you any more to do it. So if you've got no team to help you with this, these guys are there because they're based on a percentage, right? So what you make in the raise, there's a percentage, usually between 2 and 8%. It usually sits around that 5-6% kind of mark. So the more that they can help you raise, the more money they're going to make. So the incentive for them is to get you the best prepared they possibly can so they can make money, obviously. So it's a real partnership. They don't succeed if you don't succeed. If you make no money out of this, they make no money out of this, apart from the initial cost of it, which is anywhere between $250 and $2,500 to get you started. So there's usually an upfront fee, and that's charged to run what is called an expression of interest campaign that goes out to their entire database and to the world of investors, and making sure that your ASIC due diligence can be run, so that they go and say, this business is not running insolvent. It's got their books in order. They've got all the setups and the tax setups they need to have. It's to run all that. So it can run anywhere between that, so $250 for a much lower end one, up to $2,500-$3,000 as an upfront fee to do that. Now, remember though, in these kind of campaigns, you're in the hundreds of thousands of dollars that you're raising. You're not just raising 15 grand to buy some scented candle wax melts. You're going into this to do some serious scaling up of your business. So there might be, those fees might seem high, but when you see what you're making out of it, that's why it's high. There's a lot of risk that these guys take on themselves. They may then put in some marketing fees. So they might go, it's like selling a house, right? You may be liable for extra marketing fees. You want a bigger signboard out the front of the house, that will cost you more. If you want to go into 3 different websites instead of one website, that'll cost you more. If you want to go out to, you want advertising on a TV campaign and through realestate.com.au and through Facebook as well, that might cost more. So likewise in here, some of the marketing fees may be set up to prepare you for content and advertising the campaign you're trying to raise for. Third stage is all about your successful capital raise. So it's out there in the system. It's got people investing on it. And what happens is that what they mainly, so the charge that's up front is usually just to cover their costs. This is where they make their cream. So like I said, it's between 2 and 8%, usually around the 5 to 6%-ish kind of range where they'll charge. So if they make you $100,000, they're going to make, you know, $50,000 to $60,000 out of that as their fee. And that'll be extracted. You don't pay that, it gets extracted out of what's made, you get the rest. So it's always a percentage. They don't make anything, they don't make anything. So they're taking on a lot of the risk for this themselves as well. Once you've got the money, then you've got the option of some post-raise support. So this is where they help with the strategy and the execution and helping you to deal with investors and making sure that when you do get the money, they can help you to ensure that money goes the furthest it can to delivering what you promised you would deliver. So there's a whole lot of stuff you need to do with all that. But what you really, really need to do is take these optional support extras, because they're not extra. They're actually included with all the fees you're going to have to do anyway. So make sure you take all the support you possibly can. I've had a couple of friends who've raised money through Birchal. Now, this is not a recommendation at all, and I have nothing to do with Birchal, and they've had a fantastic experience. They've been in food and beverage, hospitality, and someone who was doing a retail product as well that was just selling. They were trying to get into Kmart, and they needed certain production capability. Now they're in Kmart. So they've had really good experiences with these, particularly with Birchal. They said the people at Birchal in Melbourne are very, very helpful, and they're very invested in your success because they want to succeed as well.